Here's a bet. Flip a coin. Heads, you win $150. Tails, you lose $100. Straightforward math says take that bet every single time, and yet most people offered that exact wager say no. Not because they're bad at math, because losing and winning are not opposites inside your own head. You'd need to win about twice as much as you could lose before your brain calls it a fair bet. This has a name: loss aversion. In the late 1970s, two psychologists, Daniel Kahneman and Amos Tversky, ran a series of experiments and found something that changed how we understand every financial decision since. Losing something hurts roughly twice as much, psychologically, as gaining the equivalent amount feels good. Not a little more, roughly double. It's one of the most replicated findings in behavioral science, not a one-off result from a single clever study, but a pattern that shows up again and again across different experiments, different countries, different stakes. Sit with that for a second, because it's stranger than it first sounds. It means your brain isn't actually weighing your wealth. It's weighing the feeling of a change to your wealth, and it weighs the bad changes far more heavily than the good ones. Two people with the exact same amount of money can feel completely differently about their situation, depending entirely on which direction they just moved. Now watch what this actually does inside a real portfolio. You buy a stock. It drops 10%. Selling it locks in a loss, a real, felt loss, twice as painful as it should rationally be. So instead, you hold, not because you've reanalyzed the company, because selling would force you to feel something your brain is specifically built to avoid feeling. This isn't just a theory that lives in a psychology lab. In 1998, a finance professor named Terrance Odean got hold of something researchers rarely get: the actual trading records of over 10,000 real brokerage accounts at a discount brokerage over several years. Real people, real money, real decisions, all on paper. What he found matched the theory almost exactly. These investors were roughly 1.5 to 2 times more likely to sell a stock that had gone up than one that had gone down. Not slightly more likely, a real, measurable, repeated pattern across thousands of accounts. And here's the part that makes it more than just an interesting statistic. Odean checked whether this instinct was actually paying off. Were the winners they sold about to underperform? Were the losers they kept about to bounce back? The data said no. Selling the winners and holding the losers wasn't a smart, disciplined strategy in disguise. It didn't hold up against what happened next in the market. People weren't making a calculated trade-off. They were managing a feeling and calling it a strategy after the fact. They just feel like they should be. This isn't a flaw unique to bad investors. It shows up in people who are otherwise sharp, careful, disciplined in every other part of their life. That's what makes loss aversion different from simple ignorance. You can know the math cold and still feel the pull. That's the difference between knowing about a bias in the abstract and seeing it show up in 10,000 real accounts with real consequences that have nothing to do with intelligence or effort. These weren't careless investors. They were ordinary people doing exactly what their brain was built to do: protect the good feeling, avoid the bad one, and paying a quiet, invisible cost for it, one decision at a time. And here's the part that makes it expensive instead of just uncomfortable. The same instinct works in reverse on your winners. A stock goes up 10%, and suddenly you're eager to sell, to lock in the good feeling before it can turn into a loss. So the pattern becomes hold your losers too long, hoping they recover, and sell your winners too early just to feel safe. That's backwards from almost every rule good investing is actually built on. And if you think this is just a stock market quirk, something that only shows up on a trading app, it isn't. It shows up anywhere people can gain or lose on something they own. In 2001, two economists, David Genesove and Christopher Mayer, studied something almost nobody thinks to study: how people price their own homes when they're selling at a loss. They looked at real condominium sales in Boston through the 1990s, comparing owners who bought near the top of the market and were now facing a loss on paper against owners who were sitting on a gain. The owners facing a loss didn't lower their asking price to match the market the way a purely rational seller would. They raised it. On average, they listed their homes at a price 25 to 35% higher relative to the size of their paper loss than what the market data actually supported. They did eventually get somewhat more for the home when it sold, a few percentage points more, not enough to explain the gap. But they paid for that extra ask a different way. Their homes sat on the market far longer, with a much lower chance of selling at all in any given month. Same instinct as the stock investor holding a losing position. Different asset, different decade, different country of research. Same refusal to accept the number the market is actually offering, because accepting it means feeling the loss as final. The herd doesn't just protect a stock position. It protects a story it's telling itself about a house, a decision, a version of the past it doesn't want to mark down. Knowing about a bias doesn't automatically cancel it out. It just gives you a name for what you're fighting. The herd isn't wrong because it's loud. It's wrong because it's scared. If this changed how you'll look at your next losing position, subscribe.